Even here from Share Navigator. So now we're going to look at the company debt and to see is it manageable. And if you think about now, and it's 2024 now, and interest rates have risen, okay, we may be looking at rate cuts down the line. But the higher the amount of debt a company has in this environment, the higher the cost base because the interest payments go up as they refinance their debt going forward. So that's why lots of companies in this environment, in a high interest rate environment or a higher interest rate environment, if they're not profitable, they struggle and their share prices tend to get hurt badly. And that's because their ability to repay their debt and their cost base goes up substantially. So we're looking at two figures here for Alaska Airlines. We're looking at their total debt number, and we're going back to 2017. I'll show you where we get that. And this number down here is called the debt to equity ratio. So that's just a comparison here, really, from the total debt to the total equity. So total equity includes your retained earnings, the profits of the company that the company retains, and the paid in share capital. So that's what that kind of includes there. So it's comparing that ratio to the level of debt. So the higher this ratio here, usually the worse it is for the company. But what I will say to you is before we go on, this is industry specific. Comparing the debt to equity ratio, for example, of Microsoft to an airline is obviously totally different. If you think about it, airlines, have to spend lots of money buying airplanes, and cost bases can be higher, so the debt levels tend to be higher in car manufacturers as well. So therefore, expecting and comparing the debt to equity ratios of Microsoft to Alaska Airlines is redundant. It doesn't matter. What you're looking to see here is their consistency and is it manageable. So I'll show you where we get the data first, and then we'll show you our interpretation. So you're going to go back to Alaska Airlines. We're in our paid subscription level here. We're going to go to statements, and we're going to go to the balance sheet this time. So remember to change it from quarterly to annual. We're looking for annual numbers, and we're getting 2017 to 2023. So we're looking here at the total debt here. So the total debt number is 2.57 billion in 2017, and we can see it's increased to 3.82 billion in 2023. So that's an increase. So you kind of your eyebrows would be raised, but that can be quite normal as well, guys. Lots of things can happen. For example, there might have been an acquisition. If Alaska Airlines decides to buy out another airline, they may have to raise debt to do that. And then what they do when they combine the two airlines, they repay that debt down from the profits of the merger as such. Other reasons are COVID. 2020, obviously, airlines had to borrow in order to stay afloat and keep the companies alive. And that's why you're seeing a big jump here from 2019 to 2020. So this increase in debt is actually explainable through COVID. And since COVID, the company has reduced its debt and has been paying off some of its debt. The second part of that here is actually the debt to equity ratio. So here's your total equity. And if we were to break that down, you will see the shareholders' equity here. And you can break it down right down into, well, what part of it is retained earnings and what part of it is paid in capital. Okay. So if we were to divide here, I'll just do a little test here for you to show you. We bring up a little calculator. So if we were to divide 2.57, which is the debt level, by the shareholders' equity, which is 3.46 billion, we get a debt to equity ratio of 74%. So I'm going to show you, you can calculate that out yourself if you want, but it's actually done for you when you go to the statistics page here. Again, change it to annual. And if we come down here and we look at liquidity ratios and down into solvency ratios, we look at the debt to equity ratio, and there you go, it's 0.74. So we just calculated that out. So I'm going to bring all that data into our PowerPoint presentation, and we're going to analyze it here. So you can see the debt to equity ratio has gone up along with the debt, but it's still manageable. For an airline to have this high a debt to equity ratio is not abnormal at all, actually. So I wouldn't be too concerned about the debt of this company. Yes, it has increased. Yes, they're paying higher interest payments now because of higher interest rates, but they are paying it down out of their profits. And I think this is sustainable. So I would not mark the company down for this particular debt level right here and now at this moment in time. So finally, what we're going to do now is we're going to look at retained or share buyback schemes, whether the company is actually buying back its own shares. And we'll discuss that in greater detail in the next video.